Well, later this week, we'll get the latest U.S. personal consumption expenditure price index, which is the Federal Reserve's preferred gauge of inflation. Now, investors will be keeping a close eye on it, especially after we saw some more signs of sticky inflation in the latest U.S. CPI report. Joining us now to discuss what to expect and what it could mean for interest rates is Gennadiy Goldberg, head of U.S. rate strategy with TD Securities. Gennadiy, welcome to the show.
Thanks for having me.
So, Gennadiy, we've seen signs of sticky inflation recently, and of course, more signs this morning of potential slowing economic growth with that lighter than expected consumer confidence figure. Now, later this week, we get the Fed's preferred gauge. What should we be looking for?
So we're definitely seeing a little bit of almost a stagflationary pricing, if we will. We should be definitely looking at core PCE. That's, as you mentioned, the Fed's preferred gauge of inflation is PCE. Core PCE kind of strips out some of the more volatile components like energy and food. We are actually looking for a relatively benign 0.25 month-on-month increase. And if you look at that on kind of a 3-month annualized trend, which is really how the Fed likes to look at these things as kind of a recent trend, it's actually not doing too poorly. So what I think is happening is the market is sort of worried that inflation is certainly sticky, and there are certainly worries about that at the moment. But what we're seeing is further gradual progress on inflation moderating. The issue for the Fed is that it's happening a little bit too slowly. And they certainly would like it to happen much faster, which again kind of increases the odds that they stay higher for longer, for a little bit longer than anybody expected.
Okay, so with that view in mind, what do you expect from the Fed in March?
Great question. Not a lot, unfortunately. I do think we're going to get an update, certainly, to their summary of economic projections. Those could be quite interesting. We'll see what they think on inflation, on the unemployment rate, and how many of them actually expect more cuts this year. We'll see if any of them expect rate hikes. I doubt that any of them actually upgrade their forecasts that much. What we're probably going to be seeing is a bit of a maintenance meeting to some extent. We're going to be on hold for a second consecutive meeting. We actually expect the Fed to remain on hold for all of the first half of 2025 and then only resume cuts in the second half. In our minds, this is still very much consistent with making sure inflation comes down, with making sure growth doesn't fall off a cliff. And I suspect the tone you'll see from Chair Powell and from some of the other Fed speakers is one of more moderation. They'll say, look, the market was probably unreasonable to expect a reacceleration of the U.S. economy in early in the year. What we're seeing now is a moderation back towards normal levels. It feels like things are falling off, but in reality, it's more of a leveling off.
Okay, now you mentioned that the Fed may hold off on making any interest rate decisions or rate cuts. How many cuts do you think we'll get for the remainder of the year, given this view?
So we actually still have 4 rate cuts penciled in the second half. Obviously, lots and lots of uncertainty on when those cuts actually begin, how quickly they're implemented. But I will say this, some of the data recently has been souring, as you mentioned earlier. Some of the surprise indicators, especially for hard data and for some of the survey data, really have turned quite a bit lower. Now, we're not panicking yet, and I don't think the Fed is either. But it does suggest that growth momentum might be starting to moderate. If inflation continues to gradually creep lower, even if it's creeping lower a little bit less quickly than the Fed would like, they could deliver more cuts later this year, and that's not something the market had penciled in up until very recently. The market was only penciling in about 1 cut. Now we're up to just north of 2 rate cuts just in the last couple of days.
Okay, and of course, there has been lots of news coming out of Washington recently. How are the various policy changes impacting your overall economic view?
Well, I would say that they're just increasing uncertainty. I would say there's a lot of lack of clarity among investors. Just chatting with investors, you're not seeing a whole lot of conviction in where things go next. Investors are worried about inflation continuing to move higher. If there are trade disruptions, investors are worried about growth slowing, again, on those trade disruptions, on immigration, and especially if deportations actually start to accelerate. And there's lots and lots of worries about fiscal. So these are the 3 things that the markets are the most worried about, is really trade, immigration, and fiscal policy. We've gotten a lot of news out of this administration. We haven't gotten a lot of clarity on those three things, and we're going to have to wait and see. And I think the markets are really kind of in wait and see mode at the moment.
All right, and finally, there's been a lot of interest around the potential plan to revalue U.S. gold holdings. Walk us through how that would work and what the benefit could be.
Yeah, that's definitely an interesting one. I mean, we've had some very interesting ideas coming out of this administration. The media has really highlighted a few of them. Gold revaluation is one. So right now, the value of the gold on the U.S. Treasury's balance sheet, which is actually held at the Fed, is only about $42 an ounce. It's been that way since 1973. It hasn't really changed since we've moved off the gold standard. There's an argument out there that if you just revalue the gold, which requires an act of Congress, you could effectively, quote unquote, unlock about $750 billion in cash at the Treasury. So it would require effectively a passing of a bill. But what it could do is actually help lower deficit expectations, at least temporarily, at least for 1 year. This would be a one-off type revaluation. And it could help push yields a little bit lower. Right now we're looking for the Treasury to start increasing coupon auction sizes later this year in November. If the gold is revalued, that could push off auction size increases all the way into probably fiscal 2027. And it could be quite supportive for bond investors.